This episode of Do the Work Podcast, Real Estate Edition, is brought to you by Jason Smith team at Nova Home Loans. Jason, a Navy veteran, has been recognized as one of the top 100 loan originators in the country. There is no task too big or too small for the Jason Smith team. Every client counts. For the best rates and great service, contact Jason at 480-227-6231 or visit novahomeloans.com. I personally stand by his service, and so do thousands of satisfied clients. That's Jason Smith at Nova Home Loans. NMLS number 210839.
I saw it just now.
Everybody's laughing. Everybody's laughing. Look at that.
I see Kim.
Hey, I thought the mic was muted.
Hey, no, everything's on. Look at that. Everything's on. All right, all right.
Hey, everybody does.
All right, so let's go ahead and get started. Good morning to everyone here, and thank you for joining us for what I consider a masterclass. We got two masters of the trade. We got to my left, Mr. Rio Vidrio, top producing agent here in Phoenix, Arizona, and I would say Arizona in general. And then we got a top producing loan originator, loan officer, Jason Smith. He's been recognized nationally. So guys, I'm honored to be here with you both, and we're hoping to go ahead and provide you as much information to give you the advantage on how to pre-qualify your leads and how to get them from point A to point B as quickly as possible. And that's the whole point here, is to get them from point A to point B so that you can get them their ultimate outcome, which is to buy a home. So we're going to go ahead and get started, and we're going to go dive right into this. We're not going to go about backgrounds of what you do or how you do it. We're just going to have a candid conversation. Then we're going to open this up for Q&A, all right, for Q&A for all of you. So if there's a question you need to ask, either type it in or just wait until we open up the forum. But, we all get this. We all get this when somebody calls you to, they want to buy a house. It's real easy to say, hey, let me have my lender just give you a call, right? Mm-hmm. But I think there's a lot of steps that we have to take as agents in order to make sure that we're dealing with qualified buyers, that we're, one, not wasting the lender's time. And not to say it's a waste of time in general, but,
no, never.
But how to prioritize it on your agenda, right? Because if somebody's qualified, if I have somebody that's qualified, like that is my target now. I want them to get them from point A to point B as quickly as possible. But if somebody needs credit repair or they're just not in a position to buy, then they're gonna, take, a less priority. We're still gonna work them, but it's a less priority type of situation. So, all right, so let's go ahead and get started here. So we're gonna go ahead and start with Rio, and then I want you to explain, and again, just have a real candid conversation. So Rio, somebody calls you, hey Rio, I saw you on Instagram. Yeah. Okay, I saw you on Instagram.
Never happens.
Yeah, right. And I love the houses that you're showing. I want to buy a house.
Yeah.
What are the first steps? How does the conversation take place from that point?
Typically, the conversation is, hey, I saw this house you posted, and I want to go see it. Go take me to see it. And I got to pump the brakes. I got to do a good job controlling the frame, because that's a good point. A early mistake that I did as an agent when I first started off is, you get excited about a lead that you get, and you're anxious to go out there and show them the house. And it's typically a recipe for disaster, man. The first thing I want to do is make sure that they're pre-qualified. But I make a very conscious effort to have them come into the office and have that conversation and in person. So like you were talking right now about having your clients prioritized, right? So I do a really good job on feeling my clients out to make sure that I kind of understand where they're at, credit-wise, income-wise, and kind of gauge how well qualified they are before they even touch Jason's hands.
And do you do that during the conversation on the phone, or is it always in person?
It's in person, yeah, for the most part. Now, something that I have whenever I set up a consultation, I send out a form, right? It's a short video, 1-minute video, explaining to the clients, what is expected and what type of, I ask them questions like, what's your credit range, what's your income range, and based on that, if I see that they need a ton of work, it might not be worth it for them to come in because I don't want to waste their time either, right? It could be a quick conversation. Hey, you know what? I looked over your form. It might be better for you to go straight to credit repair. But I always make it an effort that once they're done with credit repair, they always come back and they meet with me. And the reason I do this is because I want to make sure like you said, Jason's a top producing. You know, him and his team, they're great. And I want to make sure that when I send him somebody, I let them know so that way they understand, you know, what's expected. Like, hey, this is a hot lead. Like, I need this pre-qualification back within 24 to 48 hours, as opposed to somebody that's going to need more time. Hey, you know what? This is going to be a little bit of work. Send them an email, have them apply online, and then we'll work it. It's in the pipeline. We'll work it. But there's those priority clients, and you need to know and determine who are your priority clients, who's going to require that immediate attention. And I think that's something that's helped me out a lot, man, just being able to kind of...
And you're real good at that, like just prioritizing. Like send an email out basically to this client, or, hey, call this one and email them and get the application from. And you'll let me know. And I know from working with you that the ones that call, those are the hot leads. I get on it right away.
So what does it mean to you, Jason, from your standpoint? And I want to cover a couple of things that that Rio said, because he said it so nonchalant that I want to make sure that you are able to capture how important it is, okay? So I'll come back to that. But how important is it for you, Jason, to almost have a understanding of where the client falls, right? As opposed to just not knowing anything about the client, to now getting somewhat of a background where, you know, Rio asks, okay, this client is, you know, has a 700 credit score. They make about $120,000 a year. Like, versus somebody that just doesn't, you know, you don't have anything on. Like, how important is it for you, and how do you prioritize those things?
That's really important, because one, setting expectations with clients. Setting expectations with clients is really, really important. Like, when I get a client and they need credit repair, or they need this or whatever it is, or they want to be in a price range that say it's too high for what they are, Rio kind of sets that stage. So when I'm calling the client, I can kind of let them down a little bit easier, understanding that they're going to be in a lower purchase price range. So it's really important for expectations for the client to set the stage like Rio does, but also to prioritize for us, because I work on a lot of files for you guys, right? And if I'm just working on credit repair constantly, I can't be proactive to work on those clients, like you said earlier, that we really need to target to get from point A to final, you know, point B.
So again, I think this is a responsibility you all have to take as real estate agents. Okay, I know we want to prioritize everything, but we got to understand that, you know, if we bombard your partners, whether it's Jason or somebody else, if you bombard them with just you know, C or D papers kind of stuff, right, where they're not quite ready, it's going to be difficult for them to really put the priority on the ones that are, because they are bombarded by the things that, or by the clients that are not necessarily there yet. But one of the things that Rio did was to automate this process. Okay, he set the tone, he set the framing as well. He's got a process that's been proven to work, and he's able to ask questions before he even sets the appointment. So it's a candid conversation. Rio, hey, I want to buy a house. You're like, great, I'm so excited, this is awesome. Tell you what, this is what I'm going to do. I'm going to send you a link. I want you to watch the quick 1-minute video that explains some of the requirements the lender will ask. I just need you to give me a general idea of where you're at. It's going to ask you about your credit, you know, your income. It's going to ask you, what other questions do you have on that?
And I throw in there just to give them something as like, what's your search criteria? But really all I care about is, you know, gross income, monthly debts, and credit. Those are the three main things that are going to determine how solid a buyer is.
So I love that he did that. So he set the kind of the standards, and also kind of the carrot, right? Which is like, what kind of home are you looking for? So these are the questions that he now sends, and you can do this on Wufoo. You could do this on Google Forms. You can create this, but a quick video explaining what they're filling out, and now you send that over to them. Now they have a responsibility. If they fill this out, you know they're a little bit more serious, right? And when you get that back, if they say they're a 700 credit score, then it's a huge priority. I would get on the phone with my lender, say, I got a hot lead for you. I need you to get on this quickly. One thing, another thing that Rio just explained, if they're in the 5 to low 6s, say, hey, check it out. Let me know what you can do, but it's not on the high priority list. I need you to focus on my other client here. I think that's so vital.
And that's very important, because I have a team, right? I have 5 people that are licensed underneath me. So if they're a credit repair or something like that, I'd rather give it to them that they're a little less skill level than I am, a little lower. They can work on those clients because they know how to handle those, basically. So with the credit repair, I'd rather have my team work on those, so I can work effectively on the ones that are actually going to qualify, and I can get a pre-qual out quickly for you. Otherwise, it bogs down a little bit. Yeah,
and that's a service that, you know, credit repair, even though it's not, you know, instant, it's a service that's offered free to you all. So if you have a client that needs that, his team is able to work them through the process, and maybe in 6 months or a year. Have you had that situation come up where they weren't necessarily ready now, but 6 months later they were, or a year later?
Absolutely, yeah. Those are the great ones. Those are just the bonus ones that land, and you put them in credit repair. You have them set up in a mailing system, so you're still getting contacts. You're still touching them. You're still putting your social media content. So they didn't go anywhere. You didn't go anywhere, right? You're still maintaining that constant communication. So then when they do get pre-qualified and they're ready to go, you could just pick up where you left off. There's not that awkward
bonus.
gap.
You said they're bonus clients.
Yeah.
The ones that are credit repair are bonus, like Vanessa, we just got back after 4 months. That one's getting worked up today.
Yeah.
And that's like just an apple falling from the tree.
Yeah.
Unexpected.
And that's a great way to be able to still stay in contact, because if you're sending them to your lender, they should be able to turn them right back to you once they're ready. And Jason, you have a database that keeps everyone in line of like who sent you this or who sent you the lead. So even when you work them through the credit repair process, you all get that client back. And so, Rio, let me go back to your strategy. Okay, so now you have them, you talk to them on the phone or through Instagram or whatever. You send them the link, they fill it out. Their credit is not so good. What does the conversation sound like at that point? Do you still meet with them here at the office, or do you say, or does it depend on your time?
It depends on a couple of different factors, and that's when you really start kind of drill down, because maybe credit isn't there, but they have their own income or their own down payment, right? Or I get the vibe based off of the gross income that this is a pretty solid buy. They're going to be ready to buy a lot sooner. So it really depends on it's on a case by case basis. But for the most part, or not for the most part, every single client, regardless if I get them through the doors before they get sent to the lender or after they get sent to the lender, that is a very conscious thing to get them in front of you and educate them on what's expected before they end up going through and talking to your lender, right? So I make it an effort if they are going to come into the office and have an in-person consultation with me. I'm going to explain to them everything from down payment assistance, from your own down payment, interest rates, monthly payments, what's expected on the offer. I want to make sure that when they talk to my lender, it's a toss. It's not like the lender's really having to work. I've already done the majority of the work up front. Now, that's just two things. One, it maintains that good relationship with the lender, right?
Yeah.
It makes sure that, because a lot of times, lenders, they get sent everything and they have to filter through everything. If you do that up front, you're going to have a good relationship with your lender. They're going to trust that every time you send them somebody and you say, hey, this is a solid lead, like they're going to drop what they're doing, pick up the phone and call. The second thing it's going to do is if you can educate your client, you're gonna earn that trust with them.
Yes.
Right. So the trust that I've been able. There's been many clients this year that I've been able to help out that were working with other realtors that didn't have that trust factor built in. They were that typical realtor that just said, "Oh, cool, you want to buy a house here? Go talk to my lender. Come back to me when you're pre-qualified." That's a horrible way to interact with your clients. I make a conscious effort, regardless if they're qualified right then and there. If they're not qualified right then and there based on what they submitted, then I'll give them a call. Hey, I looked over your form. This, so on and so on. Let's try this strategy first. Let's get you through pre-qual first. This is what you're going to expect, and then we'll touch base. You'll come back into the office, and we'll go over the entire process in further detail. On the flip side, if it's somebody that's ready to go and I get a good buy from them, they come in, we talk, we have this conversation. I build that trust. Now they know, hey, this is a knowledgeable agent. Like this guy knows what he's talking about. And I think that's a big mistake that a lot of agents do is they don't really take the time to learn just basics, like even how to do a monthly payment. I had a conversation with Jason, and then I was like, dude, I don't care what they pre-qualify. What I care about is what's their max monthly payment. I'll figure out the rest. Like you just let me know, because every house is different. One's going to have HOA, one's going to have higher taxes, lower taxes. I've told him, I said, all I care about is the monthly payment. I'll figure out the rest, because that's all that matters. The purchase price doesn't matter. It's the monthly payment. Yeah. So just having that knowledge, man, is huge. Just being able to educate clients, and then when they go and they talk to the lender, even let's say they weren't ready to buy right then and there, and it takes them 4 months, right, to get pre-qualified. You've built that rapport with them.
Yeah.
And now they trust you and they remember you. When they come back to you, and it's been multiple times like that, where I get clients that I haven't talked to in months, we just pick up where we left off.
Because you took the time on the front end.
Yep, absolutely.
And that's so important. And listen, you also make a very conscious decision to have the meeting here at the office, right? You're not just meeting them at Starbucks or the nearest, coffee shop. Why? Talk to me about the tactics behind that, or the strategy behind them coming into the office and sitting down with you at the conference room.
It's been such a crucial thing that I've done, and it basically controls where you're the authority. You're going,
Yes.
and you know, I've had clients that they come from the East Valley, they come from far places, and I'm like, hey, I know that it's far, right? I know we're just coming to meet for an hour, but I need this. I need you to come in so I can explain the process to you. Explain the pre-qualification process, and more importantly, the offer process. Because the last thing that I want to do is go out there showing them houses, trying to explain that to them while they're excited and riled up, and you know, I want to make an offer on this house, and they're like, oh, can we ask for closing costs? It's like, no, you got to have those conversations up front.
Oh yeah, not as you're writing the offer. Where yes,
that's really important because the lender needs to echo the same thing. They need to be on the same page. When you talk about closing costs, and it's going to be hard to get those, me as a lender, I do that almost every conversation. So they're hearing it twice, and it's more of a fact at that point in time. So that's really important because this whole thing's kind of like a relay race. Rio's starting it, and then he's going to hand the baton to me. So once they get under contract, it's my turn. Now it's my time to run the race afterwards, but he's running the race and setting the stage in the beginning.
I love that whole analogy, and it is like a, you know, handing off the baton. That's so crucial. And the way you position yourself as an authority by having them come down and you know, building that rapport, and you know, a lot of agents out there complain about how my client went with somebody else. Well, I think that has to do a lot with the front end, right? Yeah. And you learned that, right? Because you had a couple people that went somewhere else and you're like, okay, I need to fix this strategy. Absolutely. And now you, even though you're busy, you're selling you're probably somewhere around $22 million this year, and you're thinking, where do you find the time? But it's so high on your priority list that you build such a reputation, a rapport with them that, let's say they can't qualify, all of a sudden you're getting referrals to their family and their friends, right?
Oh yeah, absolutely, man. And that's the beauty of taking the time to educate your clients, taking the time to meet with them. Because maybe they don't qualify right then and there, but yeah, they have a friend like, okay, I'm, you know, and it happens all the time. Like, yeah, I'm not ready to buy, but so-and-so is ready to buy.
Right.
And you'll get that phone call, you'll get that text message. So that's really important. Just take the time, you know, I know it sucks, right? You're taking time out of the day, but like I make a conscious effort every single time to have the clients meet me here in person. It's going to be great with the new office. We're going to have three conference rooms. Yeah. That's one of the biggest hurdles is trying to find a time.
I'll be there.
I mean, but now with 3 conference rooms, I mean, it's like there's no reason why you shouldn't, right? You have the 3 at the new HQ. You're going to have the one in Avondale, the one in Goodyear. It's like there's no reason why you shouldn't have your clients meeting you in person. If you feel, and once again, prioritize, right? Now, if you're not that busy and if you're a newer agent, then it doesn't matter if they need credit repair. Get them, because that's what I did. Get them into the office, because then that's where you get those referrals. So, you know, you also got to gauge where you're at, right? Yeah. When I started and I didn't have you know, a long list of leads in business, then I had to take everybody come in through the doors, because then eventually it'll get easier. You'll be able to kind of pick,
and you hone in onto your skill sets, though, right? Yeah, so you get the reps.
Yeah.
You know exactly how to convey your message, how to convey it more powerfully, how to be more just engaged, and it just develops all these skill sets on how to communicate your trade, and that's exactly what you're pretty much explaining to your clients is like, hey, I'm the experienced one, I'm the authority, and this is why you came to me. And I'm going to take the time to walk you through this entire process so that you know that I have your best interest in mind. And that's exactly what they're getting. It's not like, oh, he's just trying to sell me a house. So when you tell them, hey, you have to go $5,000 above the list price, you're also going to have to pay the seller's closing costs. They know that you're coming from a good place. You're not just trying to throw them into a house. And if you're getting a lot of resistance from your clients, is that because there's a distrust there? Yep. You didn't take the time to explain it to them. So they're going to give you pushback on everything because you're just like every other agent out there, as opposed to the top producers that understand the importance of building trust and rapport and building a relationship. They'll be like, whatever you say. Just like the way I talk to my attorneys, like he suggests this, that. I'm like, whatever you say. My CPA, whatever you say, because they build that trust and the rapport with me. And then you mirror that as well 100%. On the lending side by confirming everything that he said, where they're like, okay, now it's a fact.
Yep, now it's a fact. I've heard it twice.
I've heard it twice. It's a fact. From 2 different people, it is written in stone.
Exactly. One of the things I want to tee up on, when he said earlier about showing them a house before they're pre-qualified, recipe for disaster, you're setting expectations. Somebody's going to go out and see this house. It's $300,000. Like, oh, my God, I love it. And then me coming in on the Grim Reaper. I'm like, no, it's $270,000 you can afford. You can't get that house. Yeah. So then they start getting a little spiteful and they build this story up in their head. Our job is to take away those stories and fill it with facts. Take everything out, put the facts in there. Don't give them a reason to make an excuse why we're not doing our job.
I love it. That's great.
You got to pump the brakes. You got to pump their brakes, man, because it's an emotional roller coaster. You got to make sure that you pump the brakes, set the right expectations. That's the biggest thing that I tell my clients. It's like, hey, I got to set the right expectations. That way you understand what type of offer is required to get your offer accepted in this market. I pride myself in being able to help clients find homes, but more importantly, getting their offers accepted. And if we don't have this conversation, then it's going to make it really hard for you.
You know what's really neat about this, Rio? I remember, like, every time you had a meeting, you always, like, improved on how you would communicate with them. I remember you just mentioning to me, hey, I lost out this offer. I should have explained this up front.
Yeah.
And now you start explaining, like, hey, I can't set the expectation that I can get your closing costs covered, when that's really not a fact. Right? If you're able to get your client's closing costs covered, I mean, consider yourself very, very lucky. It's just not going to happen. So that can't be part of the conversation. Now the conversation is, you're going to have your own closing costs. This is what is expected. This is what's going to be out of pocket coming in. How did you get over, like, that hump of just giving them the straight facts and telling them what they have to come in with to work with you?
It really is just kind of the reps, right? Over time, you're going to build the confidence to tell somebody straight up, we can't go out and look at new houses that just came on the market. I just had that conversation today with a client this morning, right before I hopped on. I had a virtual call. I said, if I think I might have kicked the camera a little bit, guys. This one. I said, if, I explained to them what's required, down payment assistance and closing costs and all that. And I explained to them, what buyers are having to do to get their offers accepted. And I said, if you can't do this.
How do you explain that part so that, the agents that haven't been through that process yet, how do you explain what is required to get an offer accepted in today's market? How do you go about that?
So in today's market, I had this great speech. There's what the house is listed for and what somebody is willing to pay for the house. Right?
You guys get that? I love it.
And then who's willing to bridge that gap is who's going to win the offer over. So if the house is listed at $300,000 and we offer $330,000, right? But the appraisal swings it right back down to $300,000. Whoever can bridge the gap will win the offer. So whoever's able to pay $2,500, $5,000, $10,000 above appraisal is going to be the person that's going to win it. Letters don't help. Bottom line is what works. Who's going to net the seller the most amount of money? And those conversations have proven to be very successful. Yeah, I've lost clients throughout the way, but those clients would have never purchased anyway.
They would have wasted your time wanting to ask for a lower price.
Reductions.
Yeah, they want a home that just hits the market. They want to negotiate somehow and not realizing it's a seller's market.
Yeah. And so that conversation, though, so the one that I had with this client earlier today is I said, okay, I explained what she needed to do. She's like, yeah, I don't feel comfortable doing that. I said, that's fine. I said, the only thing we're going to be able to do right now is I'm going to send you houses, but if they haven't been on the market for more than a week, we're not going to go see them. I said, because if we go out there, you're going to waste your time. We're going to waste our time. We're not going to get our offers accepted. I said, we're going to save them to your portal, and if if they're more than a week on the market, then we'll go out there and we'll check them out. You have to have that. You got to have the confidence to tell them, like, hey, I know this is what it takes, and we can't go see new listings if you can't do this. And I mean, if they're understanding and then you've built that trust, then they're like, cool.
Like, right. Yeah, how difficult. I mean, I love the way you're just upfront talking about the facts and then sticking with your convictions, because if you waver from that, then they'll be like, oh, okay, what else is he not, is he trying to sell me? What else is he trying to sell me, as opposed to be just, working on the facts? So you almost have to have a conviction and be like, hey, this is the only way we're going to go out there and take a look at a home. And having that conversation for newer agents or those that haven't been as not, I don't want to say effective, but haven't sold as much, may have a little bit of a reservation talking to clients just like that. But I think it's so important to give them the facts up front. Otherwise, you're going to be that agent that's showing 50 houses and can't get one offer accepted. And again, if you're constantly running into that situation, it's what you did at the beginning or failed to do at the beginning, that you didn't set that expectation or that standard, that now you're at their beck and call and knowing that you're never going to get something accepted. They're going to get frustrated. You're going to get frustrated. And it's just a recipe for disaster.
Makes your life so much easier. It's like have that difficult conversation up front, and you're going to have a much more enjoyable experience, because you're not going to have the constant, oh, I found this on Zillow. I found this on Zillow. It's like, hey, I know. I've seen that. But,
and you're not catering to them, right? Once you start catering too much, you set that stage. It's a trap. You start falling into that. Their expectations are, this guy's just going to show me everything. And you're letting the this client figure out for herself, the one you're just talking to. You go, okay, we're going to show you some listings that have been on the market for a little bit. She's going to look at those, miss out on a couple of offers, maybe one, maybe not. Maybe, you're pretty good. You might get it accepted, all right? But then they'll learn on their own. You're educating them, but you know when to pull back and let them figure out for themselves, too.
Yeah. I love it. So have the difficult conversation up front versus having the awkward conversation later on down the road as you're showing houses.
100%.
So these are all little nuggets that I'm hoping that you're documenting to set up your frame. Again, set up your frame, know how to pre-qualify your clients, know how to send better qualified clients to your lender so that they can prioritize your clients and not be like, oh, okay, this person just sent me another lead that's not going to go anywhere, so I need to drop everything just to tell this person that. So a lot of it's up front. I know that this is their area of expertise, but because of Rio went above and beyond and learned everything about him. He was constantly asking you questions, right?
All the
about
time.
Every aspect and about down payment programs, about the different conventional FHA programs. And now he's gotten to the point where he just asks you for what the monthly payment's going to be.
It's crazy. Since we started working together, he's probably asked me more questions than any other real estate agent. But the way we can work together, the efficiency and the quickness, it's incredible. And the clients know. Yeah. Like, it's so easy for me. When I talk to them, they're like, oh, I heard this already. I heard this already. And it's a great conversation. I don't want you to do my job, but it really helps.
Yeah, it really helps.
It helps when you're in sync.
At the end of the day, I was having this conversation yesterday, like, I'm going to take, like, Rio takes the approach that I think a lot of top producers do, which is they take ownership of, making sure that if it's my client, I'm going to stay on top of them. So even when he sends them to you, he's still on top of you, of sending you, updates. Give me an update. What's going on with this? Text message, email, phone calls, whatever it may be. You're not just handing them off and saying, well, I hope my lender takes care of it. No. You're on top of them.
Like Thursday and Friday, he'll give me a list, like one of those days. Here, I need updates on these. And I just go through all those. I'm like, here's where we are, da-da-da-da-da. We figure it out and roll through it, basically.
With the new Sierra Interactive, that's built another tool that's going to help us be able to communicate with each other. So we'll be able to add notes to the CRM.
And I'm actually in it. That's a good point.
So with our Sierra Interactive, we're able to put lenders in. Jason's already in there. We got a couple other ones. So the key to this is to actually use it, right? To use it. So if you want to send Jason a message through the Sierra Interactive, now you have a history of all the conversations without having to look through all your emails. It's convenient, and the more you use it, the more efficient you'll become.
And then, the same thing happens a lot. I'll tell an agent, like, here's where we are, here's the expectations. Like, if we're doing credit repair, it's like 4 months out. And then I get a phone call 2 weeks later. Versus if we use the CRM, you go in there and go, okay, here's the notes. Here's where we're on this client. Okay, I remember now. Now I could focus on getting a new client instead of worrying about where we're at with this client that we're already working on.
That's huge, man.
Yeah, huge. I mean, having to look through Facebook Messenger, through emails,
text messages,
it's so tough. So if you have it all on one portal, and Sierra Interactive is available to all of you, and also our lenders are on there. So use that to your advantage. I know Rio and his team have been using it very effectively. I know Rudy uses it. I know a lot of our agents here are starting to use it to their advantage because it's all there. And if you make it a priority to always log on to the system, you'll tend to use the system. But I want to ask you something, Rio. Like, if a client says, hey, what are the parameters? And I'm asking, I know he's the lender, but I want to ask you, hey, do you think I'll qualify for FHA or conventional? Can you tell me the difference? And I want to hear from your perspective. Right. Can you tell me the difference between FHA and conventional? I'm so confused.
Right. And what's the first question you ask them?
How do you go about that?
So the biggest thing, when it comes to FHA and conventional, regarding the financing, I try to keep it very simple. And I say, look, FHA is going to be 70% of the buyers that are out there, and the reason why is they have a lot more lenient qualification measures than conventional. Conventional is a great product if you're above a 700 credit score, and certain specific scenarios, certain citizenship statuses require conventional financing. But for the most part, if we can get you qualified for conventional financing, that will be a better loan product. Your interest rate and your PMI rate are going to weigh heavily on your credit score, though. So if you're below a 700 score, we're either going to have to stick with FHA financing, or we're going to want to work on your credit to be closer to 700 to take advantage of the lower credit score, the lower interest rate and the lower PMI rate.
And the PMI is really important.
That's a big one.
not a lot of people think about that. When you're doing a conventional loan, if you're below 700 credit score, your PMI is going to be a lot higher than it is on an FHA mortgage because it's set. It doesn't matter what your score is on that. So that's an important point because these borrowers are going to be able to purchase more and they're going to feel more comfortable with the payment when you have that conversation.
Yeah. And this is for a conventional product?
For a conventional product, yes, sir.
And that's, can you tell us what a PMI is?
PMI is private mortgage insurance. That's something that came out around short history, around the 70s, 80s, because if a bunch of people foreclose on a house, the banks are now having to sell that house to recoup their costs. Well, PMI insures that bank for a certain amount that they'll get money back if that mortgage defaults. It's an insurance policy. That protects the bank. Now, a lot of people are like, oh, that's terrible. But the thing is, if the banks had to eat a lot of foreclosures just like 2008, 2009 without having PMI, it would be hugely detrimental. So it's something that protects the bank, but it's a monthly expenditure that's calculated in your mortgage payment, basically, to help protect the bank.
Can you give us an idea what the difference between a conventional PMI and a FHA is? Like, if you were to kind of round it out, is it like a is it 20% less? Is it 50% less? What would you say?
I would say it's about 40% less, 30 to 40% less than FHA if you have good credit scores. If you have good credit.
What's a good credit score?
720 or higher. 720 is kind of the bullet point. The way risk level works for all loan types is you start out at like your minimum credit score. So say conventional, there's 620, there's 640, 660, 680. It works in 20-point increments. The higher you go up in those ranges, the better the cheaper the PMI is going to be and the interest rate. So typically you want to be 700 or higher for conventional, like Rio said, but 720 is that real good point of where it makes a lot of sense.
Okay, got it.
Yeah, because sometimes, like we have a client that's currently under contract at a 650 credit score, and his PMI rate is quite a bit higher than if he was going FHA, but he has to go with conventional financing. So in some cases, FHA might be the best option.
But he's Daca.
Yeah, that's why. So Daca clients, recipients have to go conventional. As of right now, that could change possibly down the road, but as of right now, they have to go conventional. And because of that, then the monthly payment is actually higher than if you were to go FHA. So that is and that's the thing, like you got to be able to understand the differences, the product, because conventional financing historically is going to have a better chance of getting your offer accepted. Historically, it's going to be more lenient on the request for repairs when the appraiser goes out there. And also a big part of it is you're not going to be able to buy a flipped house with a FHA financing. So conventional, in terms of you as a real estate agent getting your offer accepted, it is a better product, but sometimes it's not the best solution for your client, right? Because if that higher PMI rate is going to drop your qualification, or also conventional financing has stricter debt to income requirements than FHA financing. So it might not always work out, but if you can and you can push to go that way, it's going to make your life a little bit easier. But in some cases, and a lot of the times, FHA is going to be the way to go because they're more lenient. The PMI is set regardless of what your credit score is, 580 or 700. It's still at the 0.85%, and the debt to income goes all the way up to 57%. So, but as a real estate agent, I'm always trying to get that conventional buyer, and if it doesn't work out, it's cool.
And that's.
But before you said, I don't know if you guys noticed this, but he knew what the PMI rate was, 0.85. And he also knew what the debt to income ratio was, which is 57%.
Quit doing my job.
So this is the kind of competition you have out there. So if you're not understanding these things, this is where a top producer will always have the advantage over you, is knowing the details, going above and beyond just knowing his skill set, but knowing the skill set of his lender, right? And having that knowledge. So when you're in front of your client, they know you're the real deal. the real deal.
100%. And one of the things I do love about working with like Rio and some of the other agents here is when I start talking and explaining the situation to them, they actually listen and they start asking questions. And that's the big difference between somebody who just does a deal or two a month versus somebody who does as many deals as like Rio or Rudy or something like that, is actually listening and learning my side of things. Because once an agent tunes me out and they act like they don't care and they're like, just get me a pre-qual, I don't care as much. I'll be honest, right? Because I'm like, then you're not really trying to hone your craft. And I respect people that hone their craft like Rio.
I love it, man. So what is the minimum credit score? Like if they ask you, hey, Rio, because I'm talking to you because usually the conversation goes there first.
Right.
Hey, Rio, what's the minimum credit score to get a loan? How do you have that conversation?
It depends on your funds that you have to use to buy your house. Now, you might have your down payment saved, and a lot of people, that's most of the time what they save for. But if you haven't saved for closing costs in this market, then we might need to shift gears and get you into a down payment assistance product. And if that's the case, we're going to need you to get to a 640 credit score. So you can buy if you have your own down payment and closing costs at a 580 score in theory, and sometimes lower. But then at that point, we're talking $15,000, $20,000 out of pocket. And if you have it, great. And some clients do. Yeah. But if you don't, then the conversation goes to down payment assistance. Now, down payment assistance is a great product, even if they have their own down payment, because then you have the extra funds that you need for the closing costs.
Closing costs.
And Jason and Nova in general has been one of the best companies when it comes to just openly accepting that. That's one of the biggest things that
they make less money on it. That's why. So lenders try to steer them away from that.
A lot of other lenders, they not only do they make less money, which is obviously unethical, but they also charge origination points, which makes your life harder as a real estate agent to try to get your offers accepted, or in general, because it's going to cost your buyer more money out of pocket. So those are conversations that I also have with clients if they are coming to me pre-qualified from another lender. But yeah, so depending on how much money they have is really going to determine. It's like, okay, cool. If all you have is a 580 credit score, but you have all the money that you need for your down payment and closing costs, then we're good to go. We're going to stick with just your own down payment, 580 credit score. But if all you have is your down payment, we're going to need closing costs. We're going to need down payment assistance to help you with your closing cost funds to get your offers accepted.
So see how he's setting the expectation right from the beginning. And this is awesome. And again, it takes, obtaining that knowledge first and foremost, so you can have more intelligent conversations and kind of read your clientele base. By then, you're kind of able to see what they're saying, if they're losing motivation or not, if they're leaning in, not. You can kind of see all these patterns, right, after a while for doing so long.
Dude, absolutely. And finally when I get that, when I reach out to Jason, I say, hey, look, this client, X score range, they're going to be around here. They have about this much money to play with. We're going to have to go with down payment assistance. Let's go with this loan product. So I already, up front, did a lot of the preliminary work for Jason. All he has to do is take the application, build that rapport with the client himself, but he's no longer having to pitch the products. He's no longer having to educate the clients on the products. I spent a solid 30 to 45 minutes in a consultation talking about monthly payments, down payment assistance, out-of-pocket expenses, so on and so forth. So that way when Jason gets it, passing the baton, it's more or less just him running the credit, building that rapport, and like, okay, cool, I'll get back to you in the next 24 to 48 hours.
So what about somebody doesn't have an idea of what their credit score is?
No, I got a great app for them. So
this is actually spot on. This app is.
Yeah, dude. So they don't know what their credit score traditionally up until like 5 months ago. I would say, hey, yeah, get Credit Karma, and it'll give you kind of a good range of where you're at. But there's an app, My FICO app. You can download it on App Store. You don't need an app. You can do it online. But it's $30 a month, and it will give you the actual score that lenders use. And a lot of people they use Credit Karma because it's free, and they use Experian because it's free, but it won't give you the scores that lenders use. And I used it myself personally as a consumer and cross-referenced it with Jason and his team, and I was able to use that as a gauge to determine, hey, I'm ready for my refinance, man. Let's go ahead and get it going. It's a great app. I like it.
My FICO, what is it called?
It's just a My FICO app. If they Google search it or type it up in the App Store.
And that can be kind of confusing, right? Because basically the credit bureaus have, I don't know, they all have different amounts, but it's usually about 7 or 8 different scoring models, right? So mortgage can only use 2 of those. So a lot of times clients will run Credit Karma and they're like, oh, my score is a 720. Well, I pull it and it says 660. So Rio, again, is educating and setting the stage properly. And one of the great things I wanted to mention when you're talking about this is Rio doesn't necessarily get too negative when he's talking about another product when he's steering the client, because what if we have to put them in that product?
Well, we don't use words like steering. Let's make that clear.
Exactly. Sorry, I apologize. You're 100%. But he doesn't go too negative on a product like saying FHA is bad because the mortgage insurance. He kind of asks those questions up front, versus then he can kind of guide them and talk to them with what's going to be best for them.
The last thing you want to do is pitch conventional. Oh, this is the better product. Let's try to get you for conventional. And they just had a BK 2 years ago, and they have to go FHA. Or they just had a foreclosure. Or that's an income. Or the credit.
I want to wait and fix my credit until I can get a conventional mortgage. You're like, no, you're going to lose equity. Don't do that.
You're going to lose these low interest rates. Yeah, so they both have their benefits, and knowing, like, that's surface level, right? This is before you even get into down payment assistance.
Yeah.
Man, we're talking just basics. FHA, conventional. You need to know which one is going to work based off of the credit score that your client has, based off of their debt to income. You got to be able to calculate debt to income ratios to determine which route and direction you're going to go in, and then you start learning the more in-depth loan products, the down payment assistance products, prepaying your PMI. That's been huge. So we've been talking primarily about first-time buyers for the most part,
prepaid.
right?
Yeah.
But for sellers, right, this
For
is
sellers,
such,
yeah.
you know, most sellers think, or anybody really, till this day, they think that the only way you can get rid of private mortgage insurance, PMI, which
Is
Jason
putting
talked about,
20% down.
putting 20% down. But now when you have a conversation with the seller, you can shift that conversation. You can say, hey, look, right now, if you want to sell and get into a better home, you don't have to put 20% down into your next home to get rid of the PMI. You can put 5% down, prepay the PMI. It'll cost you maybe $5 to $6 grand, and then you have all that money left over. You can use that money to reinvest in another home a couple years down the road, or start a business. But being able to speak on that with confidence, now you take a seller from him trying to pinch, him or her having to pinch every single penny or dollar that they're going to make, to try to put 20% down, because that's that magical number to get rid of PMI. A lot of people don't know, once you get rid of PMI, every $10,000 that you put down on the house is only going to drop your payment 50 to 60 bucks a month.
Exactly.
So what's the point, you know?
So let's give an example, if you don't mind.
No, this is good. And I hope everybody caught that, right? Now we're talking about, you know, a better qualified buyer, right? It's usually a better qualified buyer comes from a seller, right? Them selling their property. And what he's saying is now you're able to educate those individuals as well, saying, hey, you can use this money, not just put it into the down payment of the house, but use it to whatever you want to do, whether it's an investment, buy another property, and you only have to put 5-10% down, and it gets rid of the PMI. I think that's that's an elevated conversation, because it's not just talking about the ABCs of it. Now you're talking about like becoming an investor, using that money for rainy day, buying investment property, saving it. Like we don't know, we can use that money to have in the bank. How good does that feel?
Absolutely, man.
So give us a scenario.
I'll give you a scenario. So say somebody's selling their house and they've got $70,000, right? That's
$70,000 in equity.
Equity. That's what they're going to net after everything. And they're buying a $300,000 house. Well, if they think to get rid of PMI, they're thinking, oh my God, I got to put $60,000 down, right? In this case, we go, why don't you put 10% down? That's $30,000. And then prepay your MI, which is $5,000. So now they're coming out of pocket with $35,000. Now they have another $35,000 to work with that they have. Also, that helps when you're making an offer. If you're trying to bid over appraised value in this market or pay seller closing costs, you have more money in your pocket.
Yes.
Now you don't have PMI. You've gotten rid of that fictional thing that's in their head, because now they don't have it. They've got a cheaper payment more than likely than what they have on their current house. There's just a huge win. They could pay off debt and qualify for more in that case. They can even go higher on their purchase price. There's a ton of benefit with this.
But it's our job as realtors, as agents, as the expert, the authority, to be able to paint those possibilities. But if we don't have anything to paint, then they're going to be stuck on whatever they believe the facts are about real estate. But now you're able to paint a bigger picture, a bigger house, a bigger opportunity for them, and they can see themselves there. And that knowledge that you're gaining and these insights that you're providing right now allow you now to be able to give more value to your clients. And I love it.
Yeah, man, that's huge right there. Like that's been, I've done that a couple times this year already with sellers that are selling and buying, and having that conversation really kind of puts them off the edge of because as a homeowner, you're proud of the equity that you've built in your home, and to take all that equity from one house to the other, and okay, that makes sense if you want to save every single dollar, but I mean, we're talking 20 grand is a difference of $100 a month. Think about how much you can do with 20 grand or 40 grand. It's like, it really, like, you could just see the face light up in these sellers when they know that they're going to be able to keep some of this money. Maybe they've been, dying to buy a family car that they haven't been able to afford. Now they can pay it off cash, and they can buy the new house that they've been looking for. And maybe their payment goes up $100 a month, but had they purchased that car, then that car payment would have been $500, $600, $700 a month. So it has been a very, a good tactic to help sellers,
see something better.
See a better opportunity for their money.
And you're right. I mean, it's if they use that money to pay off the car, that was a $400 payment, and now they only have to pay an additional $50 or $100 on their mortgage. Like, who wouldn't take that? Yeah. So again, one of the things that key nuggets that they said here that some of you may miss is like for every $10,000, it only makes about a $50 difference
in your payment.
on the payment. So like these are little things that you just need to throw out so that your clients can, because this is all just the simplest form. You're not trying to overcomplicate it. You're just trying to put it in a simple form where they can understand. And I'm not saying that they're naive or dumb or anything. I'm just saying in the simplest form, you give them the facts. It's easier to make decisions when it's not convoluted with all sorts of, scenarios.
And that's really important to remember that $50 rule about every $10,000, because when you're talking about negotiating on a house and you get a counter offer that's $10,000 higher, is it worth it to you to pay $50 a month for this home? Can you see your family in there for $50 more a month? Can you change something in your budget to find $50 more a month? I guarantee they're going to say yes. Yeah. And you're going to do that on the fly versus having to call somebody and get that question answered for them.
That's been huge too, man, right there. Just being able to run payments without having to rely on a lender to give me my monthly payments, like that's just some basic knowledge that every real estate agent should have, like running monthly payments, being able to determine what, a FHA monthly payment versus a conventional payment would be. Like you should have that nailed.
And I have a good couple of apps for that.
Yeah, how do you run it? Let's go ahead and
the FHA calculator.
Yeah, so he sent me the FHA calculator, and
I want you to go ahead and send it to me so I can post it here as well.
Done.
It's a good one because what it does is so FHA requires a funding fee added into the loan, which isn't a huge amount, right? We're talking maybe an extra 10, 15 bucks a month. Yeah. But this FHA calculator automatically accounts for that into the monthly payment. And so one thing too, so what I was talking to Jason about and you about, so when it comes to your clients qualifying, lenders don't care about the purchase price. They care about the monthly payments. And not every house is going to have the same monthly payment. So that is a very common mistake that people have is they have, let's say the lender says, hey, you're qualified for $300,000 and you're stuck and you're only shopping at like $300,000, right? There might be some homes with lower taxes, lower HOA that you can increase and squeeze some more money out of that qualification. And you need to be able to determine what the monthly payment is, what their max is, and then match the house up to that loan max, right? And it makes your life easier when you're making the offers, right? Think about it. If it's Saturday night, you're trying to make an offer on a house, you don't want to have to call your lender, ask them, hey.
But you can.
You can, right. But I mean,
answer.
But
I'll text.
You got to be able to run these payments and determine, okay, yeah, you know what, this house will work and we can go up an extra $10,000 and it'll still work with the numbers. Because the last thing you want to do is get your offer accepted and then, Jason tells you, yeah, you know what, this won't work.
But right? I want you guys to get practice at doing this too, right?
Yeah.
Because the last thing I want you to do is when you're not practiced hands like Rio is over here, you set the expectation where maybe you mess up the PMI or don't estimate enough for taxes or whatever it is, and then they get pissed because they think you should know how to do this, right? But really, you're not the lender, and I'm not trying to take from you. Like, you're well practiced at this, and I want you guys to get good at this, but I also want you to depend on me and my team as well until you get to that point.
I mean, it's got to be reasonable too. You can't go from 300 up to 350 and like, oh, hey, it's got to be. We're talking pennies here, 5-10 grand at a time.
So just to reiterate what Rio said, and I think this is huge. Okay, lenders care about the monthly payment, not necessarily the purchase price. Okay, so your job is to be able to match the house that they want with that monthly payment. So you got to look at the taxes, you got to look at the HOA fees, you got to look at all these different things in order to come in at or below the payment that they're qualified for. So is that the question you ask the lender? Hey, what is the payment that they're qualified for? Or do you ask them?
I don't care what the purchase price is. I can figure that out. Is, hey, what's the monthly payment? Like where are we at? And based off the monthly payment, I can gauge if they're going to be looking in Glendale. I can gauge based off of no HOA more than likely, or Peoria, and lower taxes, as opposed to in Levine where there are higher taxes and higher HOAs. So in Glendale, Peoria, their purchase price might be $350, but if they're looking in Levine, that purchase price might be like $300. Being able to determine what area they're going to be looking in based off the monthly payment is going to help you, just.
Do you know the taxes to Peoria?
They're low, man. Pretty low. I don't know the
exact
rate.
Up with percentages.
No, they're low in Peoria and Glendale. I mean, anytime it's
I'd expect you to know that stuff.
Yeah, he keeps me on my toes. And one of the things I do is I send a screenshot to Rio of the breakdown most of the time. I need to get in the habit of doing that all the time. And sending a screenshot of the payment breakdown that shows what I'm using for taxes, what I'm using for HOA. Because realistically, if he just uses the same PMI and everything else, the only thing that's going to affect the purchase price really is the taxes. HOA and taxes, right? So if he knows what the total is of those, then he has an idea, right, to work with. Because my job as a lender, I always overestimate those, because the last thing I want to do is have a real estate agent driving around getting somebody under contract on the house where I underestimated something, and now the client doesn't qualify, and then the client gets pissed at the agent when really it's my fault.
Yeah. Well, not really, because you have to overestimate,
Yes.
but you're going above and beyond and making sure that it all fits in to be able to qualify your client. Like, these are all little nuggets. And so when you're into a situation where you're not quite getting your clients' offers accepted, you're probably dealing with somebody like this that is getting their deals accepted because they just go a little bit above and beyond. They've already prepped their clients. They know how to, double check the payment and squeeze out every little thing, every little advantage. And sometimes it's that 1 degree that'll make the difference of him getting the offer versus you getting the offer. So this is all great information. I want to get into now just a little bit of Q&A, and I know that'll spark up some questions.
Yeah.
We were going to go through the FHA conventional and the different products, but I think we're covering them in this conversation. But if you have something specific that you want us to cover, like, this is your opportunity. I can't see the screen from way back here, so I need you to either read the question or bring the screen closer.
Okay, so we have a question for Rio from Felipe Reyes.
Okay.
Rio, what's the credit repair option you recommend for clients?
Okay, so the question is, what is the credit repair option you recommend to clients?
For credit repair, I always direct them to the lender and have them pull their application so that the lender, because Jason and Nova, they have a credit repair specialist that will give them the right way, right? There's the right way to doing it, and there's the workarounds, which we don't want to advise our clients and have them do their own research on that. But the right way, the FICO specialist is going to tell them, hey, you want to do A, B, and C in order to be able to get your credit score up. And the good thing is, they have updates, so they say, hey, it's going to take 6 months, and they'll check back in 60 days, 6 months. Now, there are ways, that buyers can try to increase your score, authorize user and a bunch of other ways, but lenders are always going to give you
the best advice.
The best advice to give it, to do it the proper way.
And that's usually when I step in and I'll say, okay, get somebody to add you as an authorized user, or I fine tune things a little bit, but the most important thing to remember is, you can do a lot of damage in your credit in a short period of time, and it can take a long time to fix it, right? Now, one of the advantages of working with my credit repair people is they know what it takes to qualify for a mortgage. A lot of these other companies will do disputes and stuff like that. Well, that can cause you not to qualify. And then they spent a bunch of money on something. And realistically, most of the time, it's a client has to do the work. They have to fix their credit. And it's not somebody who can just do it with a magic wand for them.
And that's something that they can do on Credit Karma or Experian. You can do your own disputes. So, like, I wouldn't, I mean, I would stay away from those credit repair, like, outside companies and just, have them submit their application to the lender that offers that product. And then, at one point, one of those recommendations will be to dispute or remove an item that's in collections, which you, as a consumer, can do on an app, Credit Karma or Experian, which are that would be one of the differences in regards to checking your credit score. So My FICO is basically just an app to check your credit score, but to dispute items on your Credit Karma and Experian, you have to have all three, because Credit Karma is TransUnion and Equifax, and Experian is the third one that a lot of people forget about.
And I want to make one important point. I can't legally give you, as the agent, the credit repair information on the borrower unless I have the written permission from him. So I don't always do that, because that could get overwhelming, constantly trying to get permission from somebody, versus, hey, you know what, it's going to take 2 months, set a reminder, follow up with them in a month and a half, and then we're also going to follow up with them too. That way you're following up, I'm following up, and it's just, staying in contact.
And again, I would encourage you to use the Sierra Interactive site to put those reminders for yourself. Okay, you can easily go and put a task for yourself, and in a month and a half, it'll appear on your screen saying, "Oh, you got to call this buyer, or you got to double check with Jason." And this is the part that a lot of agents avoid. They want the low hanging fruit, and they don't want to nurture the clientele base, right? The ones that are not quite ready yet. But if you're able to do that, you can add an additional 10, 20 deals a year to your bottom line.
On that. It's a 27% success rate. So the other ones that don't do it, that's their fault, the people not fixing their credit. But so you send me 4 clients that are credit repair, one of those is going to close. That's a huge stat.
Man.
That's huge.
Yeah, you send you 100 in a year, you get 25 that end up qualifying at one point in the year, man. It's insane.
Bonuses.
That's awesome. Okay, next question.
It's just a comment from Bonnie. She said, I also asked to have prior prior to your taxes.
Yeah. So what are some of the, do you ask for have you worked, what are some of the other questions that you ask buyers as a pre-qualification process?
That's a big one. So we primarily have been focusing on income and credit. So when it comes to taxes, if they're a W-2 employee, you don't even need them. So don't inconvenience your seller, your buyers. If they're getting paid hourly or salary, and in some cases, you don't even need to provide bank statement or paycheck stubs, because they have this thing that Jason at Nova has. It's the work number, where if it's a big company that they work for, like Walmart or any of these bigger companies, they can automatically verify income. So they don't even need to provide paycheck stubs, taxes, or W-2s.
It's like the Rocket Mortgage thing Quicken has, basically.
Yeah. So it's not always necessary. And if somebody asks me for my taxes right now, I'd be I got to dig for that, crap. So it's rare when you need the taxes. You actually only really need them when the buyer is self-employed, 1099 like we are, or heavily commission or bonus based. But if they're just working,
actually that went away. The bonus base and commission went away. So that's nice.
They don't even need taxes anymore?
No. So
just W-2s then, right?
An important question, checkbox when you're talking to your client, you're prepping them. Are you self-employed? Are you W-2?
Yeah.
Because they changed the tax laws, so you no longer need the taxes for the bonus and commission.
Nice.
So if they're W-2, you tell them to need to have their W-2s from all their employers the last 2 years. If you're self-employed, you need to get the last 2 years, right?
Yeah.
For self-employed tax return. 2 years of that. So that's an important question to ask.
I would avoid. Yeah, I wouldn't ask. Some clients just bring them because they think they need them.
Yeah.
And I just take them and I scan them to you, but I know you don't need them.
I just junk them half the time, because the nice thing about it is, if you guys ever hear a borrower owes back taxes but they're W-2'd, I don't have to supply tax returns, which therefore doesn't show that they owe on their taxes, which means now they're qualified. We don't have to address that. So it's a nice way of leaving information out, because I can leave info out.
That's good to know.
Yeah.
I didn't know that one.
Awesome.
From Amir, I had no idea Jason was on the portal, and is it frequently monitored? So Sierra Interactive.
I have Taya, my personal assistant, who's already on that. Great idea from AZ and Rio. Actually, both of them suggested that. So she monitors that. So if a lead comes through, you can push it through there. She can assign it to me or somebody on the team, and they can jump on it right away. So if you guys are noting it, that it's credit repair, I would much prefer to have one of my team members do the application on that versus me, because I got to check a lot of their files to make sure they're qualifying your people correctly. So that would help.
And I do that too. You guys, whenever
100%.
I have a client that I know is going to need some work, I tell Jason, hey man, can you send this to one of your, I want to use Jason.
Thank you.
When I need A+ service, right? And for the most part, every client deserves it, and everybody on his team will provide it. Mm-hmm. But there's a difference, right? There's a difference.
You have to prioritize.
Absolutely, yeah. And it's the same when I use showing agents versus me. If it's a very close, friend or family or somebody at a higher price point, I have to make a conscious effort to go out there and show, right? So it's the same thing with Jason, if it's somebody that's going to need credit repair, then you want to use his assistant. So that way, when it matters, then you get Jason and you get him, to help you out. So that's huge. Because come on, there's 300 agents, Jason can't work all of our clients.
And I don't want you guys to ever just disqualify somebody, because you may be surprised. I got a lot of tricks in my bag that I can figure out how to qualify people. You were talking about even FHA earlier. We can actually go down to a 550 credit score, which is key if they have 10% down. So if they're selling their home and they say they have crappy credit, odds are most of those approve. Now you got a client.
All right, listen to that. All right, guys. So maybe that's what's keeping your client in their beat up house.
Yep.
Or their small house, right? Thinking that because they have a 550 credit score, they can't qualify. Well, they have equity. If they can put 10% down, they can go all the way down to 550 credit score.
Exactly.
And the loan limits just went up for FHA financing. So the new purchase price is going to be closer to 370, which is huge, right? That was one of the big issues with clients being able to do that, right? We've had a couple of those where if a client wanted to use FHA or only qualified for FHA due to their credit, we're talking to a seller, right? They want to move up into a nice, bigger house. They're restricted to a purchase price of $345, but effective January 2021, they can go up to a purchase price closer to 370.
Now,
what about for conventional? Where's that price?
One real quick thing. One important thing. That's a loan limit for FHA, right? So the new loan limit, which I don't have memorized, I think it's 348, right? Basically, I think that's what it is.
Well, it's whatever. So we did the math. It's 379 minus the 3.5% down, which brings them down to whatever the loan limit.
I think it's 348 loan limit. So when we're talking about having equity, right? Necessarily it doesn't mean it needs to be a 370 purchase price. They could be like 390,
Oh,
400
good
if
point.
they have
Good
enough
point.
down payment
Absolutely.
to take it down to that loan limit.
Good
Basically,
point.
so I don't want you guys to, you know, I didn't want them
But
to
it
think they were
increased in the
limited.
same increment. So it went from a
100%.
330 loan limit to 350 and some change loan limit is what it is. Yeah.
Exactly.
So did everybody understand that? Like when they say 370 loan limit,
purchase price.
that's actually based on a 3.5% down.
Right.
But if your client has 10, 15% or more, they can go up as far as they want, right? There's no limit on what kind of purchase price. They can have a 500 if they have the $100,000 or the $125,000 they need to bring it down to the I'm sorry, the 150,000 it would be to bring it down to the 348
So,
loan limit.
356.
356.
Is the new loan limit in Arizona.
That's huge.
So
So if they go 400 if they got $44,000
Yeah.
down.
It's huge, man.
Real easy. Yeah.
Okay.
That went up like 35 grand, no? Almost 40 grand? Was it before?
331 before, so $25,000.
$25,000.
Still, that's
$25,000
huge.
purchase price,
That's
yeah.
a lot.
On conventional.
What about conventional?
That one went all the way up to almost 550 for loan limit.
It's 548, 200 if I'm correct. I haven't memorized them yet, guys.
That was
So
510
I should've.
before. Like, that's huge right there, man, because,
548, yeah.
like, you know,
Sorry, it's it's 548, 250. So I was close. I was off by $50.
like, that's huge right there. You know, now somebody that was looking at a $600,000 house, before they had to put $90,000 down, now they only had to put $52,000 down.
Yeah,
like,
it's huge.
Yeah, man. That's awesome.
Good stuff. All right, next question.
From Bonnie, what down payment do you need for a DACA?
So DACA is a conventional loan only for now. So literally you could do as little as 3% down depending on the credit score, right?
Or
I mean,
if it's
that's
a first-time
obviously,
buyer.
if it's a first-time buyer, you could do as little as 3% down on conventional. Typical is 5%.
Right.
But it all depends on credit score, Bonnie, at that point in time, because then we got to figure out, you know, if it's going to DU approve, because conventional says you could go down to a 620 credit score. But you have to run those approval engines. And a lot of loan officers go, oh, you're 620, your credit score's, you know, this. I mean, sorry, your debt to income ratio is this, and you got this down. Okay, here's the prequal. But you have to run DU and LP. That's Fannie Mae's and Freddie Mac's approval engines. All lenders have to. And a lot of times, if you're a 680 and below, it's not going to approve. So then they might have to put more down payment if they're DACA.
That's a good point. So, like, if you can have all the right ingredients, and it's the most frustrating thing, but that's unfortunately what we have to deal with. It doesn't happen too often, but you can have all the right ingredients, a 5% down, the 620 minimum credit
You
score
just sent me
requirement.
one of those. 680 credit score, actually.
And conventional financing will be a little bit more finicky. You know, they can have all the right ingredients, but the automated approval engine that all lenders use might not like the application and will turn it back, where they might have to wait until they increase their credit score further, or they might have to put more money down, or they might, if they're DACA, won't be able to go FHA yet. Potentially down the road, they might be able to. But yeah, so you know, do the best that you can, obviously, at filling your clients out. But at the end of the day, don't give them that conviction like, oh, you qualify, you're done deal.
Yeah,
Still
no.
got to get that application submitted.
And then I have to smooth it all over at that
Yeah.
point in time after.
And then they hate you afterwards.
Yeah.
Oh no, I give them that. I've learned my mistakes from that. You know, I'm like, hey, you have all the right sauce, you have all the right ingredients, but we still have to run you through this automated system. You're gonna have to pull your credit, and that's usually the pushback that I get, because they don't want to they don't want to run their credit. So it's like we have to. That's the only way that we can get you officially approved.
Good. All right, next question.
From Amir, does a high income and credit score affect a buyer wanting to use DPA?
Yeah.
Well, if your income's over $109,000, then you can't do DPA, so that'll affect that. A high debt to income ratio, is that what the other question was?
They can make as much money as just not over 109.
Yeah. 109 per year. Now that you can get creative, don't disqualify people, guys, just because of what I'm telling you. Because if there's two borrowers and they both make 1 over 109, I might be able to just take the income off of one and qualify them for DPA. There's workarounds, guys. Yeah. So the important thing is to get, be fact finders in this. Get a brief idea of where they should be, but like Rio said, don't be definitive, because then they're going to be like have doubts in their head, because they already have doubts when they have to qualify for a mortgage. It's a nervous thing to do. Yeah. So you don't want them to start building stories and doubts. Just fact find and help educate them.
And keep in mind, for conventional financing, if they make over $62,000 a year, they're going to get hit with a higher interest rate than what you see
on DPA.
Yeah,
on
DPA, down payment assistance.
So on DPA, if you're over $62,000 a year, the interest rate is higher. You don't get the discounted PMI. So a lot of times it makes sense to go FHA in that case, and then we just refinance them into a conventional loan down the road.
A couple of years down the road.
Yep.
Yeah.
All right.
So once again, try to carefully when you're selling people on conventional financing, because it might not be the best solution for them, and we've had that many times.
Oh yeah,
before.
multiple times. You do a great job at that.
Next question.
Jesse said the Rio deal with prayer hands and typed in my FICO. And then from Edgar, Jason, can you walk us through the credit repair process the borrower undergoes and what it entails?
So what I like to do is I will call the borrower, or if I'm taking the app on the phone and discuss with them, go, hey, here's where your credit score is. We need to do something to get your score to this point because you either need DPA or we're trying to do this loan type. And then what I do is I send an email to Jessica in credit repair. I like to CC the agent on it, but then Jessica is not going to be able to reply with the agent on there because you can't have that information. And then basically at that point in time, once we get a time frame, I should be relaying that, or my team members to you guys. This is the time frame we're looking at, or hey, you know what, this is great. We can do a rapid rescore and we can get their score up quickly. Now, if it's a long-term client, Jessica checks in once a month and she does a soft pull on their credit, which is not a hard inquiry, and just sees if they're doing the work to get things done, which I feel like checking in with the client is great for you guys as agents, but also you don't want to get to that point of you're babysitting them and you're spending way too much time on people that may not even do the work they need to do because, yeah, maybe 27% of them qualify, but then you got 73% that aren't going to do what they need to do, and you're spinning your wheels like following up on them.
And does she update the lender via Sierra Interactive now, making sure, the agent via Sierra Interactive,
so
or how's that communication?
What Taya's going to do going forward, now that I'm in Sierra, is she's going to go into Sierra, put notes in there for me saying this is what the time frame is. So this is a learning experience for me, guys, too.
Okay.
Like, we're starting to implement these things as we go. So Taya will go in there, my assistant, when she gets the email from Jessica, and put like a time frame in there in Sierra so you guys have an idea of what it is. And then you set a reminder up in there. And I usually would say if it's like 2 months, follow up in, a month and maybe, 25 days or something like that. Like before that date, kind of follow up a couple weeks before when they're due to get their credit scores up.
But you guys still got to, like the agents are still going to require a lot of input. Like that's one of the biggest mistakes that we do is we rely on our lenders to get these clients pre-qualified and wrap them up for us when they're ready. It's still going to require some input, which is why I check on my clients every so often, see where they're at in the process. You can't just put that off into your lender. If you want that, you got to hire a full-time assistant.
And one of the things that, Jason, or you just can't provide that information to agents, the credit information, is he just can't do that unless he's got that authorization. But you can always ask your client, hey, where are you at with this? Where are you at with that? What did Jason say? And if they want to divulge that information to you, then that's fine. But he can't necessarily provide all the details of where it's at. So that's a good way to follow up with your client. Just say, hey, so how are things going? What did Jason say? What are you going to do next? Yeah. And that's also a trust issue there too, that they're not talking back and forth behind their back. Right. All right, next question.
From Fred, is the PQF monthly payment maximum the accurate amount not to exceed?
That's when you're having a conversation with your lender, because sometimes.
Okay, hold on. Let me go ahead and reread this question because I'm not sure everybody heard. Is the PDF monthly PQF monthly payment maximum
the accurate amount not to exceed?
The accurate amount not to exceed. Okay, so that's the question there.
I would say that's when you're having a conversation with your lender, because a lot of times the client will say, I don't want a payment to be over this. Right. And then generally what I'll do is I'll make the pre-qual for about $20,000 or so over that amount for them, basically, and say this is where they want to stay payment-wise. So $270 works for them, but I'm going to go ahead and write you the pre-qual for like $290. Now, each agent's different, right? If you want me to write the pre-qual for the max, I'm going to write the pre-qual for the max, but I'm going to tell you where the client kind of wants to be payment-wise. And generally, that usually ends up being $10,000 or $20,000 more. They end up paying more than what it is.
I always tell Jason to give me their max, because it's going to do two things. You're not going to be asking for another pre-qual at 10 o'clock at night when you try to write an offer. And two, it's also going to set the it's going to let your buyers know, like, hey, you could qualify for more. Just know that this is what you have available, but we're shopping well under budget.
And also, what does it do for the listing agent?
Makes it look like it's a better qualified buyer.
That's exactly
gone are the days when you ask your lender for a pre-qual that matches
for exactly
the
the
purchase
amount, because you don't want them to know they qualify for more. Like, but when really they know what you're doing, though.
That's such an old tactic, man.
Yeah, that's an old school tactic.
Old agents ask me
don't do that.
So now that's a great strategy, because there was a time when it's a buyer, when it's a buyer's market, you don't want to divulge what they can qualify for all the way. You want to negotiate. So if it's a house that was listed for 300, and you want to offer 290, they can qualify for 350. You don't want to send the 350,000 pre-qual. You want to send the 290. So I would always ask for that lower.
Both of us
the
suggest
lower.
that.
But now
100%.
you just ask whatever they can qualify for. Like send that off so they can also see how qualified your client is. So if they're seeing somebody that can barely qualify for this home because it's listed at 300, they send a $300,000 pre-qual, and somebody else comes in with 375.
Yeah.
You know, it's, they're probably going to be more likely inclined to accept the higher qualified buyer.
Absolutely.
Okay. From Meg, how much should buyers have for closing costs?
How much should buyers have for closing costs?
I would say roughly a rough estimate, about $5,000 is a good estimate because that covers prepaids, taxes, and insurance. But then they also need appraisal and a home inspection on top of that.
Depends on purchase price too. Like if we're talking 300,000, maybe 5,000. You know,
What about
300,000 or less.
I would
What
say
about 400?
I
4 or
would
5?
say 6,000 to 6,500, and it depends on HOA too. If it has an HOA, if it doesn't. I stick with the 5,500 rule if it's anywhere under 300, and then if it's anywhere between 300 to 500, I say 6,500.
And that's generally what I do. And if it ends up being higher, I usually have a little bit of room to give a credit or something like that.
As long
just
as
to
you're
make
not
them
using
happy.
DPA.
Exactly. With DPA, I can't really do credits unless it's something where, you know, appraisal came in low and we're just trying to make the deal work. Then I have to go to corporate to get that.
Yeah, that one's tough.
Good, like little nuggets here.
Yeah.
Great nuggets.
Question from Fred. What are the max DTI ratios for FHA, DPA, and conventional?
So debt to income ratios for the different loan programs.
So
FHA is so much
FHA is 56.9.
Write this down, guys.
Without DPA though.
Without DPA. With FHA without DPA is a 56.9 debt ratio.
A debt
Now,
ratio.
there's something important there. It's going to confuse you. There's two types of debt ratio, housing and a total expense ratio. The 56.9 includes the new housing payment and all the debts on their credit. The housing ratio, it cannot take up more than 46.9% of their income, right? That's another thing with FHA that lenders can fall into traps. And they're like, oh, my God, we're below 56.9. And they write a pre-qual, they don't run DU, and then the housing, you know, is too much for their income level.
That's going to get a little bit complicated. So what I would say is, for the most part, that qualification amount is going to include the housing ratio. You know, at the end of the day, it comes down to the monthly payment, though. So you're going to give us a pre-qualification based off of what they qualify for. So once again, do the best you can, right? Run the numbers, 56.9. But get the final housing ratio and debt to income ratio from your lenders, you know, because that's a big mistake too. And
I want to throw a caveat in there too. Don't get too caught up on the debt ratio all the time because they may have like an installment loan or something that they owe less than 10 payments on. I can exclude that payment in most cases, right? So don't disqualify them right out the gate. Go, you know what? You know, let's talk to the lender. I've got a brief idea this might be where you are, but he might be able to figure some things out. And then if I do figure that out, guess what? You look like a champ because I'm able to get them a higher purchase price because I'm your source. Like you came to me.
That applies to car payments too. If somebody has a car payment that they owe less than 10 months on, they can disqualify that
Or
loan.
we can have them pay it down less than 10 months to get qualified.
Nice.
So to answer,
that was FHA.
FHA, but with DPA, it's 50%.
DPA is 45 or 50% depending on the credit score. If you're below 660, I don't want to get too in depth. You can only go to a 45% credit score. Actually, no, they did away with that yesterday. So no, it's just a 50%. They changed the guideline yesterday.
So we'll just ask the questions to Rio now, okay?
No, he didn't know that.
Thanks for joining us, Jason. All the questions now going to Rio.
Here, you want my computer? I'm gonna give you the mortgage system now.
Conventional is 50, but man, it gets tricky at 50. 45 is really where you want to be, and doesn't matter if that's DPA or not.
Well, a lot of times it doesn't want to approve with DU, like we said earlier, if it's over 45. But they changed the guideline yesterday. It was a COVID overlay. They got rid of it, which means things are getting better, guys. Guidelines are starting to get more lenient. Nice. So now we can go to a 50% on conventional or FHA when it comes to DPA. And then what was the next one? Was it a conventional? What the debt ratio is on that? That's the same thing. It's a 50% debt ratio on those. A lot of times it may not approve over 45, but it will allow you to go to a 50 depending on a bunch of other parameters.
Be cautiously optimistic about when you're running those payments with clients.
Yes.
And those scenarios.
Okay.
Two more from Maddie. Do you think we'll get another DPA program like the 5% non-forgivable that will be going away this month?
Yes. Yes, I do. I've been talking to Dirk Swift, that's the head of the Home Plus, and I check in every week. I'm like, where are you at with this? So a lot of you guys are posting how the 5% DPA is going away. It's the 5% non-forgivable that's on the rate sheet on there. And what that means is you have the non-forgivable and the forgivable DPA. Well, the 3% rate where they forgive the money that they give to them for DPA is the same as the 5% non-forgivable. And what they mean by non-forgivable is if you sell the house or refinance, you're always going to have to pay that money back. But like in this market, it's a huge advantage because you got a lower rate and you got more money to use for closing costs. So it's a great program. So yes, to answer that question, Dirk has some things in the works. He's the head of the Home Plus that will bring that back. Something similar. It's not going to be the same, but we'll have something for that. But let's just keep telling people that we can do this program. Now, one piece of information I wanted to put out on this, I might as well do it while I got everybody here. Typically, lenders require you have a conditional approval in underwriting to lock the rate and reserve the funds for those DPAs on this program that's going away.
Please tell me that's going away.
I got an exception from corporate where if you guys could get somebody under contract by, let's say, the 28th of this month, they'll allow me to lock and reserve those funds before it goes away.
That's
beautiful. Guys, if you want to put a sense of urgency with your clients, right there.
Yeah, the 28th of December, you're
28th. You got 13 days.
Keep in mind, the non-forgivable only works if they're under the income limit of $62,000, though. So if you make over $62,000, the non-forgivable doesn't work.
But again, remember, I might be able to use income for one borrower or another and still finagle it and make it work.
Yeah, I use the non-forgivable a lot this year. Yeah, it helped me for sure.
Last question from Kimberly. Does checking your credit score on the MyFICO app affect credit at all?
No, it didn't. It's just like using Credit Karma or using Experian app. It hasn't on me. No, I don't work for MyFICO, but for me, it hasn't affected my score. It doesn't show up on my credit report. Yeah.
Typically, consumer products are not supposed to ding your credit score. It's only when it's pulled by a third-party source, like a mortgage company, auto loan company, that'll affect it. And
I actually can pull a soft pull on clients now. And I can write a pre-qual off that if they're good enough and I'm not worried about it not DU approving. I can't run DU with the soft pull, but I can pull that on clients that are really, really hesitant and scared about the process. And it will not lower their score when I do a soft pull on that. But at least it gives me all the meat and potatoes on if I need to advise them on things. And this works for a lot of clients where let's say they're 4 or 5 months out. They don't want to break their lease. They don't want to pay for it. It's really good to get them in the saddle with me where I can do a soft pull on their credit and start advising them and setting the stage for when it comes time so they can start prepping. Yeah. And that's another great advantage that we can do too.
All right, off subject a little bit since you brought it up. What is your advice if individuals are still 6 months away from ending their lease?
Yeah.
And they want to buy, but they also don't want that that burden of that payment. So how do you advise them of that?
That's typically a common objection that I try to overcome. So you want to give them the sense of urgency, obviously, and I have a client like that right now. Interest rates are low, prices will continue to rise for the next year or two. When you buy a house, right, you're going to skip a month. So typically when you cancel your lease, to break your lease, it's 2 months worth of rent. So let's say, they're paying $1,000 a month. To cancel the lease, it's going to be, double that. If you close in January, your first mortgage payment isn't until March. So if you time it right, a easy way is to say, hey, look, that 1 month that you're skipping, right, where you're not paying any rent or any mortgage, that's already paying for half of your lease break fee. And then you would just be responsible for the leftover amount. Some apartment complexes allow you to carry that out in monthly installments. And that's a big misconception, too. A lot of people are afraid of breaking their leases. Well, not only that, but they think that affects your credit. It doesn't affect your credit to break the lease. It only affects your credit if you don't pay the lease break fee. That's the amount that goes into collections. But there's nothing wrong with breaking your lease as long as you pay the fee.
And it's really important because what will happen is if they don't make those payments on breaking that lease, they'll charge them the full amount that they had left on the lease on there. But that's important with this this non-forgivable that's going away for people that are out. That's probably why you asked that question, AZ, is some people may be 4 or 5 more months out. And it might make sense to break that lease because you're getting your closing costs and your down payment mostly covered. Now, another important point that you guys drilling in is how much your homes are going to appreciate by this year. What is it, like maybe 8%, if not
17,
more?
17, I thought I saw that it was
17.
This year, I thought I saw somewhere it was 17.
So let's say it's 10%. Let's just say 10%. So $300,000 is going to cost them $30,000 more in purchase price if they wait 12 months. Yeah. Divide that by 12 and say every month you wait, your purchase price is going up by this month. Does it make sense to break your lease?
Absolutely.
Oh, my God. When they see that, they're going to be like, yeah, I'll break my freaking lease. I'll buy a house.
Yeah, that's a good point.
Mm-hmm.
We we have one more question from Fred.
All right.
What is the URL for Rio's introductory video and form?
What is your?
So for the consultation form, it's therealdeal.com/consultation. And for the just initial fill me out type, it's therealdeal.com/ that one I don't know. Hold on.
The Real Deal. How I can type it in.
The consultation form is therealdeal.com/consultation. And that one is the one where I give them a brief description of what they should expect when we have our consultation. And that's when they fill out the form to let me know what their credit score and all that is. And then when I have clients that are just wanting to know some basics, therealdeal.com/home buying basics. That one is just a short video explaining, a little bit of DTI, out-of-pocket expenses. And I'll send that to clients that just constantly keep asking questions through Messenger. And I'm like, hey, watch this. If this makes sense, then let's go ahead and schedule a time to meet. So I kind of give them that cutoff because they keep going and asking questions. And it's like they're scared to make that commitment.
So again, like Real's coming in here giving you all this insight.
Tons.
It's your job to actually apply it. I mean, if he's got a quick video, you got all the inspiration you need to make your own. And I appreciate you being so open with your strategies. And I love that about how we run here at A's and Associates is people want to work with other people that are pushing their limits, because that will in turn fire him up, right? He's got a few people right behind him that are trying to catch up. So there's always that fire going on. And it's so important that you raise your level of awareness and also of sales, right? So that we can all grow as a big team, big brokerage. So.
It's just fine tuning, and in this market, like being that precise is going to get you way more deals accepted, way more.
Adding to it, man. Always learning, always adjusting, always adding new stuff.
All right, and I think that's all the questions we have. So I hope you found this very informative. Thank you, Rio, the Real Deal, for coming in here and giving us your time and expertise to be able to help everyone here watching, right? To raise their game. And, of course, Jason, for coming in here and dropping the knowledge, even though I think I got more votes for Rio, now handling all the loans. But
Rio Deal Mortgage.
There's Real Deal Mortgage.
No.
All right, guys. Thank you. And we'll talk to you soon. Have a great day. Bye now.
Thank you for joining us for this episode of Do the Work Podcast, brought to you by Do the Work Coaching and Consulting. You can watch this and other episodes by subscribing to our channel on YouTube or by visiting our site directly at dothework.com. For our audio listeners, you can listen to this episode and many others on your preferred podcast provider. Finally, to stay up to date on the next time we will be going live, follow us on Facebook and Instagram.
This episode of Do the Work Podcast, Real Estate Edition, is brought to you by Jason Smith team at Nova Home Loans. Jason, a Navy veteran, has been recognized as one of the top 100 loan originators in the country. There is no task too big or too small for the Jason Smith team. Every client counts. For the best rates and great service, contact Jason at 480-227-6231 or visit novahomeloans.com. I personally stand by his service, and so do thousands of satisfied clients. That's Jason Smith at Nova Home Loans, NMLS number 210839.